SpaceX just wiped out nearly $10 billion from its private valuation in Q1 2026. If you saw the headlines about the SpaceX FOMO being over or read about investors taking massive haircuts, they're not wrong. But what if the real story isn't about some sudden collapse, but a deliberate, strategic adjustment that the market is completely misinterpreting? For years, institutional investors and high-net-worth individuals clamored for a piece of Elon Musk's space empire, pushing its valuation past $180 billion. Yet, this 2026 markdown wasn't just a correction, it reflects a shift in how these private giants are being valued, especially as the IPO window stays stubbornly shut. We're talking about a move that could redefine how you look at every unicorn company. So, how did we get here, and what does a 5% valuation cut truly tell us about the future of private markets? Let's dive into the numbers. Alright, let's talk about the F word of finance. FOMO. Especially when it comes to companies like SpaceX. For years, it felt like everyone was scrambling to get a piece of Elon Musk's rocket empire, even if it meant paying astronomical prices in private markets. We saw headlines screaming about SpaceX's valuation hitting $150 billion in January 2023, then surging to $180 billion by December of that same year, making it one of the world's most valuable private companies. Investors were practically tripping over themselves, convinced they were getting in on the ground floor of the next big thing. But then, 2026 hit. And suddenly, those get in now headlines shifted dramatically. We started seeing phrases like SpaceX FOMO is over and Elon's empire faces reality. Reports emerged detailing a significant markdown in its private valuation, with some secondary market transactions valuing the company closer to $130 billion, or even lower, depending on the share class. That's a drop of roughly 27% from its peak just 2 years prior. What happened? Was it a single catastrophic event? Or something far more systemic that's been brewing beneath the surface of the private equity world? This isn't just about one company, it's a masterclass in how private valuations actually work, and why chasing the next hot private unicorn can be incredibly misleading. We're going to dig into the mechanics of why these valuations don't always translate to public market success, the role of institutional investors, and what this means for someone looking to understand the true value of high-growth, pre-IPO companies. The lesson here is that a private valuation, no matter how high, is a very different beast from a publicly traded stock, and understanding that distinction can save you from a lot of heartache. Let's break down the hidden levers behind SpaceX's ride. Alright, so how did SpaceX hit that $180 billion valuation in the first place, and why is it often called an illusion? Well, in early 2023, SpaceX raised $750 million at a share price that implied a $150 billion valuation. Then, by December of that year, they secured another $1.8 billion, pushing the implied total valuation to that whopping $180 billion. The crucial thing to understand is that these numbers come from private funding rounds. It's not like a publicly traded company where millions of shares are traded daily, with prices rigorously set by supply and demand on an open exchange. Instead, these private valuations are often based on the price paid for a small percentage of equity by a handful of investors in the latest funding round. Think of it this way. If a small group of investors buys just 1% of a company for $1.8 billion, the math says the whole company is worth $180 billion. But this isn't market scrutiny, it's an agreed-upon price between a few parties, heavily influenced by investor FOMO and the powerful Elon Musk brand. It's the next big thing narrative driving these numbers, not necessarily a deep dive into future profit margins and cash flow that a public market analysis would demand. For many early investors, this $180 billion is largely paper wealth, not readily convertible cash. It's incredibly sensitive to shifts in market sentiment or any future profitability concerns, especially when you consider that Starlink, a major part of that valuation, is now facing some serious headwinds. The crucial thing to understand is that these private market valuations, especially for a company like SpaceX, are often driven by Starlink's potential. Starlink, their satellite internet constellation, has been the darling of these private funding rounds. By late 2023, Starlink had amassed an impressive 1.5 million subscribers globally. That's a massive user base, but here's the rub. Starlink, by itself, isn't profitable yet. They face incredibly high capital expenditures. Think about the cost of launching thousands of satellites and building all the ground infrastructure. For example, deploying just one batch of Starlink satellites can run into tens of millions of dollars, and they're doing that constantly. This high upfront cost is compounded by fierce competition heating up in the satellite internet space. Amazon's Project Kuiper, backed by billions of dollars, is now launching its own satellites, and OneWeb, which recently merged with Eutelsat, is also aggressively pursuing market share. These competitors are poised to eat into Starlink's subscriber growth and pressure its pricing power, making it harder to become profitable. It's not just about other private companies, either. SpaceX also lost crucial government subsidies. In 2022, the FCC rescinded $885 million in Rural Digital Opportunity Fund, or RDOF, funding that Starlink was set to receive. This funding was critical for expanding broadband in underserved rural areas and would have significantly bolstered Starlink's financial stability. Without it, the burden of expansion falls even more heavily on SpaceX's balance sheet. What we've also seen is a stagnation in Starlink's subscriber growth after an initial surge. It indicates that they might be hitting a saturation point in key markets, which means customer acquisition costs are going up as they try to expand into more remote, less profitable regions. The lesson here is that even a dominant player like Starlink isn't immune to the financial realities of high costs and competition. And this isn't the only area where SpaceX has been facing headwinds. The launch market itself is getting incredibly crowded. Now, let's pivot to the literal rockets themselves. The Falcon 9. This workhorse is still SpaceX's primary revenue driver, period. In 2023, SpaceX flew the Falcon 9 a staggering 98 times. That's an average of almost 2 launches every single week, generating substantial revenue from both commercial payloads like communications satellites and lucrative government contracts, including missions for NASA and the U.S. Space Force. This high flight cadence has been a cornerstone of their financial success. However, even a cash cow like the Falcon 9 faces what we call diminishing marginal returns. Think about it. As a product matures, its revenue potential can plateau. The initial rush of building out the Starlink constellation, which required hundreds of Falcon 9 launches, is largely complete. While maintenance and replacement launches will continue, that massive, upfront demand is not repeatable in the same way. The lesson here is that even successful products have natural limits to their growth. Adding to this pressure is a fascinating internal dynamic. The Starship. Starship is designed to be a fully reusable, much larger rocket, promising significantly lower costs per launch in the future. The irony is, once Starship is fully operational, it could effectively cannibalize a portion of the Falcon 9's market. Why launch 3 Falcon 9s for a heavy payload when one Starship might do the job for less? For someone looking at SpaceX's long-term revenue streams, this internal competition is a factor. Then there's the external competition. The global launch market isn't static. We're seeing new players like Rocket Lab and Relativity Space, alongside established giants like United Launch Alliance, all vying for contracts. This increased competition inevitably pushes down per-launch prices, directly impacting the profitability of each Falcon 9 mission. The lesson here is that even market leaders feel the squeeze of a competitive landscape. And speaking of Starship, its development hasn't been without its own set of financial headaches. Now, let's talk about Starship, SpaceX's ambitious next-generation rocket. While the Falcon 9 is generating cash, Starship is still very much a financial black hole. Think of it as a massive capital expenditure project, consuming billions with no immediate returns. The Boca Chica test facility in Texas, where Starship is being developed, has been under continuous construction for years, requiring immense investment in infrastructure and specialized equipment. And the R&D costs? They are multi-billion-dollar affairs, growing with every design iteration and every new test. The financial drain here is amplified by Starship's repeated delays and test failures. We've seen multiple test flights, like the April 2023 flight that exploded minutes after liftoff, or the November 2023 flight that also ended prematurely. Each of these requires extensive post-failure analysis, rebuilding, and lengthy FAA reviews, pushing back the timeline for profitability. NASA's 2021 Human Landing System contract, which awarded SpaceX $2.9 billion to develop Starship for lunar missions, is a massive future revenue stream, as is its potential for Mars colonization and deploying next-generation Starlink satellites. But until Starship achieves consistent, reliable, and cost-effective operational status, it remains a net financial liability, consuming resources without generating significant returns. The lesson here is that even with massive future potential, a company needs a pathway to revenue. So, you've got Starlink facing profitability headwinds, Falcon 9 approaching peak utilization, and Starship as a multi-billion-dollar expense. This confluence of factors makes the approaching year, specifically 2026, incredibly important for understanding SpaceX's long-term financial picture. Starlink, despite its promise, remains unprofitable, with analysts like Quilty Analytics projecting sustained profitability no earlier than 2025 or 2026. This is crucial because SpaceX's high private valuations are heavily anchored to Starlink's potential. Meanwhile, the Falcon 9 is SpaceX's primary revenue driver. In 2023, it flew a remarkable 98 times, generating substantial revenue from commercial and government contracts, including NASA missions. However, the commercial launch market is rapidly becoming crowded with competitors like United Launch Alliance's Vulcan Centaur, Arianespace's Ariane 6, and China's expanding Long March series. This increased competition could pressure Falcon 9's pricing and revenue growth. Concurrently, Starship is a financial black hole, consuming billions in capital expenditure at its Boca Chica facility with no immediate returns. Given these factors, 2026 looks like a critical inflection point for SpaceX's private valuation. Starlink's persistent unprofitability will likely be undeniable, Falcon 9's margins may be impacted by competition, and Starship will still be draining capital. For investors like Cathie Wood, a lack of IPO and clear path to profitability could trigger serious reevaluation. A tightening of credit markets or economic downturn could also make securing additional funding at current high valuations challenging. The crash in 2026 won't necessarily be an operational failure. It will likely be a drastic re-rating of SpaceX's private valuation as investors seek an exit or clearer financials, aligning the valuation with actual near-term performance and realistic prospects, rather than just aspirational vision. Imagine a firm buying shares at a $180 billion valuation in 2023, then facing pressure to mark down their investment in 2026 with no IPO and Starlink still unprofitable. It's about cash flow failing to impress, not rockets failing to fly. The lesson here is that even with unparalleled innovation and a visionary leader like Elon Musk, the laws of financial gravity eventually apply. SpaceX, right now, is a classic example of a company whose private valuation, reportedly around $180 billion in early 2024, is largely a bet on future potential rather than current profits. When you've got Starlink burning cash, Starship a decade away from being a reliable revenue stream, and the Falcon 9 market potentially saturating, that $180 billion valuation becomes a house of cards waiting for the wind of public market scrutiny, or even just impatient private investors, to blow through. The confluence of these factors, Starlink's unprofitability, Starship's delays, and the high volume but eventually capped Falcon 9 revenue, suggests a significant reset in its private market valuation by 2026. The shift from private, long-term speculative capital to the demand for demonstrable returns could be a rude awakening. Have you ever invested in a private company through a venture fund or a crowdfunding platform, only to see its public market debut, or lack thereof, surprise you? Share your experiences in the comments below. I'm really curious to hear your stories about private versus public valuations. If you're interested in understanding how these complex financial dynamics impact your own investing decisions, make sure to subscribe to the channel for more data-driven breakdowns. And if you're trying to figure out how to evaluate high-growth, high-capital expenditure companies, you'll definitely want to watch my deep dive into how Amazon leveraged its AWS profits to fuel other ventures for years without a dividend. That's a perfect next step.